While everyone was selling PayPal from $300 all the way down to $40, legend investors like Michael Burry and David Einhorn started buying the shares. Burry even publicly argued that PayPal real intrinsic value is between $75 and $115 per share. On top of that, news broke that Stripe and Advent International made a massive $33 billion buyout bid, which is $60.50 per share, even as PayPal management considers spinning off Venmo. What do these investors see that other investors are missing? I'm so curious. So let's find out. PayPal originally spun off from eBay back in 2015. I actually owned the shares back then, but I sold them in 2020. Looking at PayPal today, it looks like a totally different company. Of course, PayPal is still making money by facilitating digital transactions, charging merchants a fee every time a buyer checks out, alongside peer-to-peer payments through services like Venmo. First, I wanted to understand, with digital spending hitting records high every single year, how did PayPal stock crash this hard? I found a couple of disturbing problems, but also two major reasons that were completely outside of management control. Back in 2015 and the years following, fintech companies were in the exact same hype cycle we see with AI stocks today. Investors truly believed that these platforms would wipe out old school banks and credit giants because their services were faster and cheaper. It was framed as the future and the numbers seemed to back it up. We were talking about 20% to over 100% annual revenue growth from top players alongside explosive user adoption. And it makes sense. When you're really small, then it's very easy to double your users and also your revenue and earnings. And then you, of course, had people moving back then money in and out from crypto exchanges during the 2017 and 2020-2021 crypto bull runs. A whole wave of new companies rushed to Wall Street like Adyen, Stoneco, Klarna. And on top of that, these fintech companies got lucky in 2020 during the global lockdowns. Online order volume exploded, of course, and digital payments became mandatory. This pushed valuations of these companies to crazy levels. PayPal itself traded near 90 times earnings, sending its stock to an extreme peak of $300 per share. But then the growth of the hype ended. And instead of relying on the stories, Wall Street started demanding actual underlying earnings. The multiples came down, and so the price also of the companies. This was something out of control of the company. Outside of the market conditions, PayPal created 5 massive problems for itself. Losing eBay in 2020 because their agreement to be eBay's primary payment processor ended. Those were some of their most profitable transactions. Then the second is fake accounts. In 2020, bots created 4.5 million fake accounts to abuse cash promotions, which PayPal initially included in its user growth numbers. Third is competition. Apple Pay and credit card networks crushed them in physical retail. When lockdowns ended, consumers wanted tap to pay in stores. And it took PayPal nearly 2 years to catch up. And then we have fourth, and I remember this well, because in late 2020, an updated policy drafted threatened $2,500 for misinformation posted on private social accounts. That decision alone turned off millions of users. I also stopped using PayPal. Last but not least, the fifth problem they created was security outage. In mid-2025, a critical payment processing glitch in Germany allowed unauthorized charges, forcing European banks to temporarily freeze transactions and pushing merchants towards regional alternatives. And all these problems led to this huge stock drop. And currently, Wall Street analysts are rating it at a hold and maintaining the price targets around $50 to $55, sitting at a low price earning ratio of 11. Before we go into the numbers, quick disclaimer, this is of course not financial advice. Always do your own homework, and remember, with investing you can lose all your money or even more. The ticker name is PYPL. In 2015, PayPal handled $282 billion in total payment volume. By 2025, the numbers exploded to $1.79 trillion. And as you can see with the green line, TPV was growing over 20% every year, peaking at 33% in 2021. And then it started to slow down to 6.7% in 2025. That's the red line. So how does PayPal actually make money? They take a small fee from every merchant payment before settling the rest. In 2015, PayPal took $2.88 for every $100 processed. By 2025, they just took $1.66 per $100. So they're making way less money on every dollar flowing through their system. On the chart here, the blue line represents transaction revenue. In 2025, the transaction revenue grew 3.5% to $29.7 billion, and transaction fees account for roughly 90% of PayPal's total revenue. And the remaining 10% is coming from interest, credit revenue share, merchant lending, and honey, growing at 7% per year on average. Now the active accounts grew from 305 million in 2019 to 439 million in 2025. But accounts actually dipped in 2023, as you can see. So this shows a minimal growth recently. We know value investor Michael Burry loves massive free cash flow and low debt. So here comes the fun part. PayPal's free cash flow went from 5.3 billion in 2020 to 5.5 billion in 2025. But those numbers include heavy stock compensation, averaging 1.3 billion a year and 1 billion in 2025. Every time I see these huge stock compensations, it reminds me that I really chose the wrong career path. Now, when we take out the stock compensation, then the adjusted cash flow is around 4.5 billion. Now, the most important, of course, is what is PayPal doing with the cash besides spending on compensations? Well, they are buying back stock aggressively. Since 2018, they have spent over 16 billion retiring 23% of the outstanding shares. They still have $13.9 billion authorized for buyback shares, with another 3 billion in buybacks slated for this half year. So end of the year's shares outstanding should be dropped to roughly 820 million. And this is beautiful because the debt is minimal. That's about $13.3 billion, and it cost 450 million in annual interest. At a $60 stock price, assuming 5.5 billion in 2026 cash flow across 820 million shares, you get 6.70 of cash flow per share. That's a price to free cash flow ratio of just 8.9 times, or 11.3% in earnings yield. Now factor the potential of Venmo spin-off. Venmo is growing volume at 12% to 40% versus the rest of PayPal, which is growing at 2 to 5% a year and generates $2 billion in revenue and I estimated $400 million in free cash flow. At a 5 times to 7 times price to sales multiple, Venmo alone is worth $9 billion to $14 billion, or $11 to $70 per PayPal share. If you pay $60 for the stock today and subtract Venmo's $11 to $70 value, you're getting the rest of PayPal for just $43 to $49 per share. The rest of PayPal still generates $6.20 in free cash flow per share. I can understand that Michael Burry and David Einhorn are invested in this company. After seeing the sum of parts and the free cash flow, what's yearly coming in with the buybacks, and from my understanding, Michael Burry bought it at $44, but still $60 is a reasonable price. And Michael Burry even stated that its value is between $75 to $115. And that makes sense. Before we go over my take, I want to share this first. While researching the company, I read through the CEO's shareholders' letters, and it was always so fascinating. If you only read those letters, you have no clue that the stock fell from $300 down into the 40s. Everything was going amazing, and every issue was blamed on micro problems. They even write about they donated shareholders' money to charities, but there's no real self-reflection. And when you go over the annual report, notice how as soon as numbers slow down, management shifts which key performance indicators they use. It really looks like there's more value inside the company, but there's also a flip side. What if the take rate keeps declining? That's their core business, accounting for roughly 90% of the revenue. If unbranded processing, where they earn far less per transaction, roughly 0.3%, keeps growing faster than the core PayPal checkout button, where they make roughly 2.25% netto, they just keep making less money on every transaction. And imagine what happens if the volume stops growing. Regarding the buybacks, PayPal can buy basically all the shares in 10 years. But buybacks only work if core business survives. Remember Sears? They poured billions into share buyback while the underlying retail business completely dissolved. Personally, I would rather see that the company buy back less shares and pay a higher dividend to the shareholders. In the end, it comes down to your own risk tolerance and portfolio setup. I will definitely keep watching PayPal, especially to see if that Venmo spin-off actually goes through. If you found this video helpful, just let me know in the comments.